Global companies require massive, permanent pools of capital to build factories, fund research, and expand operations. But the people who actually have that money, everyday investors, only possess short-term savings. You might be willing to invest today, but you need the flexibility to pull your cash back out tomorrow. Companies bridge this gap by issuing stock. They offer pieces of ownership in exchange for the cash they need to grow. This initial exchange of money for fresh shares happens in what is known as the primary market. But permanently surrendering your savings to a corporation carries an obvious risk. If you face a medical emergency or decide to buy a house, you cannot simply ask the company to return your cash. They have already spent it building that skyscraper. That creates an illiquidity problem, which is solved entirely by the secondary market. This system allows you to sell your existing shares to another investor whenever you want. You get your cash, and the new buyer assumes your ownership stake in the business. The major stock exchanges we see in the news do not actually raise money for companies. They exist to inject liquidity into the system. Knowing you can exit your position at any time is the exact safety net that makes you willing to part with your capital in the first place. When you decide to buy a stock and tap the purchase button on your screen, you don't deal with the exchange directly. Whichever method they use, brokers operate under a legal mandate called best execution. Regulators require these firms to take all sufficient steps to secure the optimal outcome for you, factoring in the lowest possible price, your total costs, and the speed of settlement. Once the broker has the order, they usually route it to a stock market. These are on-exchange transactions. They occur on highly centralized, supervised venues like the New York Stock Exchange, executing millions of standardized trades in a highly visible environment. But massive or obscure trades often bypass the central exchanges entirely. Two parties will negotiate the transaction directly in the over-the-counter or OTC market. This structure sacrifices some visibility, but provides the flexibility needed to move huge volumes of illiquid assets without alerting the entire global market. Back on the public exchange, your order hits the matching engine. This software is the mechanism that officially discovers the exact price of an asset at any given millisecond. This order book shows the mechanics of an order-driven market. It utilizes an electronic ledger to match buyers and sellers directly, completely eliminating the need for middlemen. The engine pairs participants based on strict chronological priority. It evaluates the price you want and the exact number of shares you requested. If multiple investors demand the same price, the system awards the trade to whoever entered their order first. The weakness of a purely order-driven market becomes apparent during a crisis. If everyone suddenly wants to sell and the buyer queue empties, the matching engine has nothing to pair you with. The market freezes. To prevent liquidity from vanishing, venues like the Nasdaq employ a quote-driven system. It serves as a structural failsafe to keep assets moving regardless of broader economic panic. This flowchart illustrates the foundation of that system, the market maker. These are specialized financial institutions that are obligated to provide continuous prices for a stock, stepping in to buy or sell when natural trading dries up. They maintain this liquidity by constantly quoting two prices. They state a lower bid price, which is what they will pay to take shares off your hands, and a higher ask price, which is what they charge to sell shares to you. The gap between those two numbers is the spread. Market makers earn that spread as their profit, their financial reward for risking their own capital to buy stock in a falling market. So when you hit the buy button, your order is secured by a highly engineered matching system. Whether you are paired organically in an order-driven queue or your trade is absorbed by a quote-driven market maker, the infrastructure ensures your request is fulfilled in milliseconds. Zooming out, this exact process is happening millions of times a second across the global financial system. All of that microscopic trading produces one massive macroeconomic output: price discovery. By constantly pairing buyers and sellers, the market assigns an objective, real-time value to millions of assets. Centralizing all this activity reduces both the time and the transaction costs investors would otherwise waste trying to hunt down trading partners on their own. With clear, accurate prices established, investors know exactly where to allocate their funds. Capital naturally drains away from stagnant industries and routes efficiently toward high-growth, innovative companies. Equity markets process the chaos of individual human decisions into an orderly, liquid reality. By offering everyday investors the freedom to exit at any time, they secure the long-term capital required to build the future.